We're now going to look at the sales side of our inventory. So at this point, we have purchased our inventory. It's sitting in our store, and a customer comes, picks something off the shelf, and takes it up to the cash register and to purchase it. So the first thing that we're going to look at is, what if the customer is paying cash? So let's say we have a tablet that we are selling, and we purchased the tablet for $350. So let's say we purchased this tablet for $350. And of course, we need to sell it for something more than that to make any money. So let's say we are selling it for $500. All right, so the customer comes up to the cash register and hands us $500 in cash or a credit card. And in this class, they are treated the same. Most retailers treat cash and credit cards the same in their journal entries anyway, because the cash is almost immediate, whether they're actually using cash or a credit card. So we treat them the same. So whether it's cash or a credit card, we're just going to debit cash. We got $500. All right. Now, this is where we kind of have to look at things a little bit differently. And usually I ask students, well, what else has happened? And students will often say, well, we don't have inventory anymore. So I'm going to put that way down here. What has happened to our inventory? It has gone down $350. That's what was in our inventory account for that tablet. It cost us $350. Inventory has gone down $350. So you can see there's a difference between the $500 and the $350. And this is where students usually get a little confused, saying, all right, well, where's that other $150 going? There's actually two things happening when we have a customer buy something from us. The first thing I like thinking of as the interaction with the customer. So the customer gave us $500 in cash. Why did they give us cash? We actually did some work. So if you think back to when we were doing service businesses, a customer gave us $500 cash because we did some work, and that went into a revenue account. Well, it's the same thing here. We have done some work on behalf of the customer. We sold them this tablet, right? So the other half of this cash entry is actually sales revenue. We did $500 worth of work for our customer. All right, so that's the first part. This is actually a whole journal entry here, and this is our interaction with the customer. The other journal entry is down here, and it is we have used up some of our inventory. And I like to think of this as similar to when we used up supplies. In a previous chapter, we looked at that journal entry. When we use up something, that's an expense. So when we used up supplies, we would credit supplies and debit supplies expense. It's the same thing here. We have used up inventory. We no longer have it. It's gone. And so the other half of this journal entry is some sort of expense. We are going to call this expense cost of goods sold. And I usually abbreviate this. I usually abbreviate it COGS or COGS. And the expense is $350. So we have two journal entries here. One is, again, the interaction with the customer, recording the revenue or the amount of work that we did for the customer. And the second one is recording the expense associated with using up our inventory. And now that inventory is gone. So that's the expense right here. Another concept that we'll explore more in depth in a future video is the concept of gross profit. And we often understand this intuitively, but let's look at it from an accounting standpoint. We have our sales revenue of $500 and our cost of goods sold of $350. how much money did we make? We made $150, and that's called our gross profit on this sale. Again, we often intuitively understand that. If you, for example, if you are involved in selling stuff on eBay, you might be looking for deals at garage sales or at thrift stores. This is kind of a thing where you go buy things at thrift stores and then you go sell it on eBay for a higher price. Of course, you are probably going to be tracking how much all of that stuff cost you so you don't lose money when you go sell it on eBay. It's the same thing here with a merchandiser. If you're selling stuff on eBay, you are a merchandiser, and so you're often keeping track of how much money am I making on each sale. That's what we're doing here with the journal entries, is we have our revenue right there. How much did we get from the customer? And comparing that to our expenses, or how much did that thing cost us? All right, so that's a basic sale. We also have to look at what if instead this was sold on account, meaning that the customer did not pay us right away. So this is more often with like bigger ticket items. It might not be the small stuff in like Target or Walmart. All of those things are pretty much paid for right away. But think more like an appliance store where it's bigger ticket item and you might not be paying right away. So we might have customers that aren't actually paying us cash right now. Instead, they are buying it on account. So instead of cash, we're going to put accounts receivable there. And then when we actually collect the money from the customer, we are going to get the cash of $500 and credit accounts receivable of $500. So just one extra step there if the customer is purchasing it on account, that we, instead of putting it in cash, we put it in accounts receivable. And then when we pay us, we get the cash and we remove it from accounts receivable. All right, let's make sales just a little bit more complicated now. Just like when we were purchasing stuff, guess what? We can give our customers discounts as well. So let's take a look at that. Let's do the same thing here, that we had accounts receivable of 500, set up the same thing here, and we had sales revenue of 500. So customer owes us $500. That tablet that is now no longer in our store cost us $350. And we did that. All right, so that's the point where we're at. We offered our customer, let's say, terms of 210 net 30. So very common terms that are given. And so that means if the customer pays us 2% within 10 days, or if they pay us within 10 days, they can take 2% off the price. In this case, that 2% translates to $10. So if they pay us within 10 days, we're only expecting $490. All right, let's take a look at, well, we can, like the purchasing side, we can look at this two different ways. One way is the two-step process, and I actually prefer this when we're learning the two-step process. Let's say the customer sends us the money within the 10 days. What we have to do is we have to take $10 off of their bill, right? So they don't owe us that $10. So I need to credit accounts receivable $10. And where does that go? Well, it's as if this $10 sale never happened, right? So we didn't actually do $500 worth of work. We only did $490. So we would debit sales revenue. Now, right now, temporarily, I am putting in sales revenue because what we're actually doing is reversing part of that sale. So it's as if that sale didn't happen. In the end, we're not going to use sales revenue, but I'm just going to put it there right now as a placeholder. And then the second step is the customer actually paying us. They sent us cash of $490, and then they paid off their account. How much was in their account now? If we actually look at the accounts receivable, we had 500, we took off 10, and so now our accounts receivable is showing that they only owe us 490, and indeed, that is what they paid us. So, but just like the purchasing thing, this is a two-step process that can be combined into one. We have the accounts receivable that is listed twice here. So if we're trying to combine the two journal entries into one, we are going to combine the similar accounts. Sales revenue, that's the only one. So I'm just going to bring that one right over. I debited that 10. The the cash is also by itself. So let's look at that first. Cash is also by itself. So that's the only one. I debit cash 490. I have two accounts receivable. They both happen to be debits. Since they are both debits, I'm going to combine them into one number. And that number happens to be 500. So I credited accounts receivable $500. So again, I like learning it in a two-step process because for a lot of people that makes more intuitive sense. But your homework is going to want the one journal entry. And like the purchases, I'm going to say that there's another way of looking at this. The first way of looking at it is cash. How much cash did we get from the customer? We got 490. If our accounts receivable, let's look at if we only did this, skip the two-step process and did one journal entry. How much is in our accounts receivable? Well, there's 500. How much is the customer paying us? They're paying off all of it. So they're paying off the full, whatever is in the accounts receivable. You want to show at the end that they don't owe us anything, which means we need to take off 500. That's right there. And where does the $10 difference go? It goes into the sales revenue account because to update how much work did we actually do, how much did we actually get from our customers. So we didn't get 500 from our customers, we only got 490. All right, now for the last step on the sales discount. I said that sales revenue, I was putting it there as a temporary holder there because that's what makes sense where the sales revenue is just showing how much work we did for our customers. However, it is important to track how much discounts our customers are actually taking. And using this process with just putting everything in the sales revenue account, if I have $500 there and I take out 10, it shows 490. I am not tracking the discount. So all that's going to show up on my financial statements is this 490. I actually have no idea how much the original price was and how much discounts customers took. And most people consider that an important thing to track. Most businesses, I should say, want to track the discounts that are being taken. So for most businesses, and for purposes of our homework, we are not going to use the sales revenue account directly. We instead are going to use sales discounts. Now, what type of account is sales discounts? This is very similar to the accumulated depreciation account that we used a couple of chapters ago. And this is a contra account. It's a contra revenue account. So contra accounts are used when you don't want to put everything directly into its related account. So with the property, plant, and equipment, we had some equipment. We don't want to directly reduce the equipment when we depreciate it, so we're going to track it in this separate account. We do have to combine them in the end, but we want to track the two things separately. Same thing here. We want to track our sales revenue what the actual purchase price was versus the discounts that were taken, because it's valuable information to keep track of both of them. So instead of putting the $10 in the sales revenue account, I want to keep this at $500 to show what was the actual sales price when they came into the store, and then how much of a discount did I give them. And I gave a $10 discount. So the $500 credit combined with a $10 debit, that's what's going to be shown on the income statement, so someone can actually look at that and say, okay, I can see how much the list price was, how much in discounts were taken. It's still $490 in net revenue, but I can see the breakdown there. So we are going to use the sales discounts account when we are tracking discounts we have given to our customers. All right, so that's sales discounts. The next thing that we need to cover is sales returns. And so you can see that there is a parallel here with our purchases. We also did purchases and purchase discounts and purchase returns. Same thing here. Our customers also might be returning stuff to us. All right, so let's increase this a little bit. Let's say that we sold our customers 4 tablets for $2,000. So, and let's say it's on account, so they owe us $2,000. So we have our sales revenue here for $2,000. And then we have our cost of goods sold and our inventory. And since the tablets were $350 each for us, we're going to put $1,400 here. All right, so we send the tablets to our customers, and one gets sent back. Now it could be slightly damaged, and or maybe it's the wrong color. Maybe we messed up their order. Whatever it is, they send one of those back. And we are assuming in this scenario that we can resell that inventory. So we're going to take that one tablet and put it back into our inventory. So like the original sale, there's actually 2 things happening. One is our interaction with the customer, and the second is we are getting inventory back. What we're actually doing is just reversing everything from the original sale. So the first thing is we need to reverse out part of this. We did not earn $500. So one of those tablets was $500. So we didn't earn that $500. And the customer no longer owes us $500. So we're going to take that out of accounts receivable. All right, so that's step 1. Step 2 is, hey, we got this tablet back. We're going to put it back into inventory. That tablet originally cost us $300. It's as if we said, oh, we sent it out, but it's like, well, maybe we didn't, right? So we got this tablet back, so it's $350 back into inventory. And we are just going to reverse out this expense. We thought we had this expense, but it turns out we didn't actually have the expense. This is one of the few times that we will credit an expense, and one of the few times we will debit a revenue. All right, so this effectively reverses all parts of the sale. However, one little more wrinkle here is that we are not going to use the sales revenue account. Like when we are doing sales discounts, it might be important for us to track our sales returns. What if we see a big increase in sales returns? What could that mean? It could mean that perhaps our products are not as good as they were before. Or maybe whatever the sales price is too big and they're having buyer's regrets, so they're sending things back. Whatever it is, we probably want to track how much is being returned to us. And I actually find this more important to track than the sales discounts. So instead of putting it directly in sales revenue, which would, again, lose all of that information for us, we are going to put it into another contra revenue account called sales returns and allowances. So just like sales discounts, this is a contra account. So if we combine this with our sales revenue account, and so we'll have sales returns. Sales revenue is going to have the full $2,000 in here. The sales returns is going to have $500. Combined, they still end up at $1,500. But having the two different accounts enables us to put on our income statement, we can put sales, 2,000, minus sales returns, to have net sales of $1,500. So again, we still end up with that $1,500 number, but having the sales returns contra account enables us to preserve this very important information so that we can look back and see, hey, how much are we getting, is being returned in our sales? And we might make important business decisions off of that. So that's why we're using a contra account instead of putting everything directly into the sales revenue account. Okay, just like the purchases now, let's combine these concepts of the discounts and the returns into one problem. What happens if a customer returns some goods and then they take the discount? So one more thing here. All right, so let's set this problem up again. We sold the $2,000 in tablets, and those tablets cost us $1,400. And then we are giving our customer terms of 210, net 30. Meaning our customer is probably going to take the discount. If they pay within 10 days, they're not paying us the $2,000. They're paying us $40 less, so $1,960. However, before the payment comes in, the customer calls us up and says, hey, one of these tablets is no good. Can I send it back? And we say, sure, you can send it back. So we are going to reverse that out. We are going to use our sales discount instead of sales revenue to take out that $500. Take the $500 off of their bill. So let's go make sure we track the accounts receivable. We had $2,000 in it. We took $500 off. They owe us $1,500. All right, and then whenever we return something, we also have to reverse out the inventory. Again, this is assuming that we can reuse the inventory. All right, so at this point, the customer owes us $1,500, and they now pay us what they owe us. But we said, well, if they pay within the discount period, they can take a 2% discount. That's $30 off. They're paying us $1,470. So we're only going to get cash of $1,470. How much of this $1,500 are they paying off? They are paying off all of it. So let's go ahead and make sure that we put the full $1,500 here. Where does the difference go? This $30 difference. We are putting this in the contra account sales discounts. So I just want to point out here, we have two contra accounts. Now, we could put sales revenue directly here, but generally we want to track our sales discounts. Oh, I put the wrong one here. This is supposed to be sales returns. So we have sales returns and sales discounts. Both of those, presumably we could just debit the sales revenue account directly, but these are two important things to track. So we are going to put them in their own separate accounts so we can break out the detail on the income statement and see all of those different things on there. All right, so that's sales. We can see that the sales process mirrors the purchasing process pretty closely. We can buy things on cash. We can sell things with cash. We can purchase things on account. We can sell things on account. There's purchase discounts and sales discounts. There's purchase returns and sales returns. And then the combination of the discounts and the returns might make our math a little bit more complicated. But if you can do the purchasing side, and you can probably do the sales side. There are slightly different accounts in there, but they are very similar. And also don't forget about looking at the terms and what you calculate the terms on.